You've heard somewhere that you can use your super to buy a property. You've probably also heard that you might be able to borrow money to purchase a property within a SMSF. And while this is all true, there's a few things you need to understand first, and I'm here to show you. G'day, I'm Chris Strano, the founder of Super Guy, the place where Australians go to maximise their super and build their own retirement plan. If you're new here, make sure you click the subscribe button and the notification bell so that you get notified each time I release a new video. And if you get value from this video, make sure you give it a thumbs up. It takes 2 seconds and it lets me know that you like the videos and it motivates me to make more. Alright, let's get started. When it comes to purchasing property within a self-managed super fund, it's reasonably straightforward. However, if borrowings are required to assist with the purchase, then things can get a little bit more complex. Let's take a look at a limited recourse borrowing arrangement. A limited recourse borrowing arrangement is an arrangement required to be established when you are purchasing an asset within an SMSF and will be needing borrowings to assist with the purchase. Now, this type of arrangement in almost all cases is used to purchase property, but it is not restricted to the purchase of property. So here's how it works. If you have a self-managed super fund with, say, $500,000 spare in the bank account and wanted to purchase a $500,000 property, the SMSF could simply purchase the property outright, just as you would if you purchased a property in your own name. However, given the SMSF is the owner, all rental income would need to be paid into the SMSF bank account and all related expenses would need to be paid from the SMSF bank account. But what if you wanted your SMSF to purchase a $500,000 property using only $200,000 of the cash available in the SMSF and $300,000 of borrowings? Well, you would need to establish a limited recourse borrowing arrangement, referred to as an LRBA for short. And the way this works is that you need to set up a separate trust known as a bare trust. The bare trust will hold the property on trust for the SMSF while there are borrowings in place. And once all these borrowings have been repaid in full, the property is then transferred into the SMSF and the bare trust is closed down. During this arrangement, all rental income is still paid to the SMSF bank account and all related expenses, including loan repayments, are still paid from the SMSF bank account. The bare trust has no other assets other than the property and no income or expenses itself. Does that make sense? The reason this is referred to as a limited recourse borrowing arrangement is because the recourse of the lender is limited to the property only. Therefore, if for whatever reason the SMSF was to default on the loan, then the lender would only be able to take charge over the property to repay the loan. No other assets are available to the lender as security. The recourse is limited to the property itself. And what this does is protects all of the SMSF's other assets from the lender and is the reason why a separate bare trust needs to be established. So for example, if you wanted your SMSF to purchase 2 properties using borrowings, you would need to set up 2 LRBAs with 2 separate bare trusts, because part of the rules state that borrowings can only be used for a single acquirable asset, meaning 2 properties cannot be held within one trust. So the limited recourse borrowing arrangement can be used to purchase commercial property, residential property, land, shares, managed funds, or any other asset allowed by the SMSF's trust deed and investment strategy. In fact, before entering into an LRBA, you need to make sure your self-managed super fund's trust deed allows for an LRBA and that the intended investments of the SMSF will be consistent with the investment strategy of the fund, which is a formal document. What about the source of the borrowings? Well, this can come from a commercial lender, such as a bank or so on, or can be a related party loan, say from you personally to your SMSF, provided it's done at arm's length, on an arm's length basis, under standard terms that would be expected from a third party loan. And it's important to be aware of the risks, costs, and obviously the process involved in setting up a limited recourse borrowing arrangement. A bare trust with a corporate trustee will usually cost around $1,500 to $2,000, and you might also need to pay, a few $100s for a trust deed upgrade and a revised investment strategy, if that's what's required to purchase the property and set up the bare trust. You might even need to obtain advice from a financial planner, which is definitely recommended, because getting this set up wrong can be very costly or could cause you to breach superannuation laws. So advice will usually be around $3,000-4,000 at least. And it is a requirement for most lenders that you have sought and obtained professional advice regarding the proposed purchase if you're looking at borrowing money within a self-managed super fund. So all up, you could be looking at about $6,000, and that's assuming that you already have a SMSF in place. Otherwise, there's at least another couple of grand just to set that up. So even if the prospect of using your super to purchase property sounds good, you really want to crunch the numbers to see if an LRBA is suitable for you, because the costs can be high and the overall process can be quite onerous. So what do you reckon? Are you going to borrow to purchase property inside super? I'd be interested to hear your comments below. If you've learned something new from this video, make sure you subscribe to the channel by clicking the subscribe button. And if you want more exclusive superannuation and retirement tips, head over to superguy.com.au and sign up to my newsletter for free. That's where I share my best content. Stay super and subscribe. See ya.